We believe we are an operating company. We have talent, we create products, we create value for our shareholders. We can do thousands of different things. We aren't regulated as an investment company is to passively hold and just do one thing and have one fixed mandate. We can use that capital to buy other companies. We can use that capital to innovate and do R&D. We have all the flexibility as the management team and as the board of the company chooses.
To someone who understands Bitcoin, how would you explain MicroStrategy to them, or strategy rather now it is called? How do you explain what the company does, why it does what it does?
Yeah. So to understand strategy, you just need to understand and appreciate what Bitcoin is first. And I think the simple explanation is Bitcoin is digital capital or digital gold. It's a scarce virtual asset that has no counterparty risk, that is a great tool for long-term capital preservation, and hence it's digital capital. It's a good store of value for 50 years, 100 years, 1,000 years for either an individual like you and me, or a company, or a nation state, or a family office, or anyone, any entity. So that's digital capital. And strategy is a digital treasury company or a Bitcoin treasury company, which is capitalizing on this digital asset, Bitcoin. And what that means is we are continuously raising more and more capital and buying more and more Bitcoin. And we're reinvesting the cash flows from our software business and also buying Bitcoin with it. So what it's effectively become is it's become a company that issues different kinds of securities and stocks that people can buy to get different kinds of exposure to the underlying asset, Bitcoin. If you're buying the common stock, MSTR, the common shares, you're getting levered exposure to Bitcoin, which means if Bitcoin is going up 2x over 5 years or 2x over 3 years, because of the leverage on the balance sheet, the common stock might go up more. 2x for Bitcoin, maybe 3x for the common stock, maybe 4x. And if not the common stock, then we have these different kinds of preferred stocks, which are this hybrid between debt and stock, where they give a fixed return, kind of like debt. So, just simple illustration being a fixed 10% return, as opposed to, the volatile nature of Bitcoin, where it's maybe 30, 40, 50% return, but it's very volatile. You can just kind of strip away part of that volatility, strip away some of the performance as well, and strip away some of the risk because it has more Bitcoin backing each share of that different class of preferred shares. So you can buy into that fixed income sets of shares, or you can buy the common stock. And in that way, different investors, either individual or institutional, who can buy Bitcoin or cannot buy Bitcoin, can also then, buy these different instruments and get different kind of risk reward exposure to Bitcoin. So I hope that's a, decent description or illustration of what strategy is.
But if you had to explain how strategy makes money, how would you do that?
Yeah, so strategy makes money now by effectively issuing digital credit, which is what we call these different preferred stocks that offer a 10% return to the investor, taking the capital and buying Bitcoin that's appreciating, let's say, on average 30% per year for the next 10 years. And that spread between 30% to 10%, let's say the 20%, is the spread that the company is capturing and the value it's creating for the common shareholders. And that's the business. And it's a similar business to, let's say, banks or insurance companies, in the sense that they also have, different kinds of liabilities. And then they invest on the other side in different kinds of assets. We've just chosen one asset, being Bitcoin. But that's the whole business model, that you are securitizing Bitcoin. And in the nature, when you're doing that, you are creating these digital credit instruments that are these perpetual swaps, perpetually offering 10% to the person who wants 10%, and then offering the spread to the common investors.
Okay. So can you just lay out the different credit instruments that strategy has in maybe a chronological order, and the reason why they went from one to the other to the other?
Yeah, sure. So we started the Bitcoin journey in 2020. And at the time, we first put just the cash on the balance sheet, about $500 million into Bitcoin, and then opportunistically tried different kinds of debt. And I think understanding that evolution makes a lot of is very helpful to understand where we are at today. So we tried senior secured debt, which is, you take some of your assets, in this case Bitcoin, you create an encumbrance on it, you raise some money, raise some debt, where this Bitcoin is kind of the collateral in some sense. It's a secured loan, and we borrowed $500 million and took debt on the balance sheet to buy more Bitcoin. We also tried a margin loan where we posted Bitcoin as collateral and borrowed money from Silvergate Bank, and there was different thresholds and margin call limits and so on and so forth. There was a small piece of a Bitcoin stack, but we tried that as well. We tried convertible debt, which is debt that's convertible into common equity at a point of time in the future at a predetermined share price. So we tried these different kinds of debt, and we had, I think, decent success with all of them. But we realized that they have some defects which are not perfect for the Bitcoin Treasury model. And as a Bitcoin Treasury company, if you're investing in an asset forever with a perpetual time horizon, but that asset happens to be volatile in the short term, you don't want to take debt that has maturities coming due in 3 years or 5 years or 8 years. You want to stretch that maturity as far out as possible. So that was one big learning, which was kind of shaping our thinking on what is a superior form of credit to take on a balance sheet. And second, with the convertible debt, we were trying to see how to stretch that conversion premium as well, to a bigger and bigger amount. We were raising convertible debt at a 30 to 40 to 50% premium.
Can you explain what that means?
What that means is, if the stock price of a company is $100 today, and I go out and raise money by issuing new shares, I can issue the new shares at $100.
Correct.
Raise a lot of money. Or I can issue convertible debt, which is, let's say I raise $1,000, which is debt today, but it can convert to equity 5 years out, but not at $100, which is the share price today, but instead at a premium to $100. Let's call it a 100% premium, which means $200. So right now on my books, on my balance sheet, it's a $1,000 debt, but 5 years later, the debt holders can convert it into equity at $200, meaning for $1,000, they'll get 5 shares each. And 5 years later, the debt will go away, and instead 5 new shares will exist on like my balance sheet.
What happens if the stock price is not at $200?
So at that time, 5 years later, the debt holders will then get repaid in cash. So I'll have to give them the $1,000 back in cash. So it's either being settled in cash or in stock. And if it's in stock, then it's at the predetermined conversion price. So it always depends on, at the time, is the share price above the conversion price or below? If it's above, it's in their best interest to receive the shares. If it's below, then it's in their best interest to just receive the cash. So they get to choose what they want.
Okay. And if it is below that conversion price, then strategy will need to pay them in cash.
Correct.
And that's not something that strategy wants to do.
Exactly. Because then that introduces the necessity of either selling the Bitcoin, getting the cash to repay them, or you can refinance it. You can raise another convertible debt tranche or another kind of loan or debt or equity, just raise money elsewhere and then kind of repay them with that. But you don't know what the market conditions might be there, and you don't want to be in that kind of scenario. So that is what we wanted to eliminate.
Yeah, so that was your learning from issuing convertible debt.
Correct.
That you want to move to a model where it doesn't come due at all, which is where your perpetual preferreds came in.
Exactly. So what we did is we said that what form of debt can I take which has no maturity risk, where there is no redemption date, there is no date where I need to repay my debt holders. And the answer is, it's actually equity. Forget preferred equity. Even if you think about common equity, what any company typically has, or what a startup also has when they raise money from VC investors, equity doesn't have any maturity. Once you raise capital, it's permanent capital. It's just with you. You can choose to give dividends, and you can choose to have buybacks, or you can choose to wind down the company and repay the investors. But otherwise, there is no date as to which you need to do it.
Correct.
So typically people understand common equity, which has, the greatest risk, but the greatest upside as well. But then there's a hybrid between common equity and debt called preferred equity. And the word preferred over here means they have a liquidation preference, which means if the company does wind down its business and has a liquidation of all its assets, they get paid out before common equity. They're senior in this waterfall or capital stack. The debt holders are first, then the preferred equity, and then the common equity. But in addition to that, liquidation preference seniority, they also have typically a fixed dividend that is allocated to them. And in our case, it's mostly 10%. And the company or the board can choose to suspend the dividends if they want, but typically they don't. And typically they just pay out this fixed 10%. So if the company is performing better than that, they typically don't get to see the upside beyond that. It comes to the common equity. If the company is underperforming, they still typically get the 10% and the shock is absorbed by the common equity.
Yeah.
So it kind of, acts as the best form of leverage we can get, because we want to have someone who wants a fixed return so that we can keep the excess return, and we don't want to have maturity risk with that. So this preferred equity that's perpetual in nature, perpetual preferred equity, is the way to solve for it. So we've kind of innovated in this market, introduced 5 different kinds of perpetual preferred equity instruments with some varying characteristics, and we've kind of leaning away from convertible debt. We still have a lot of convertible debt outstanding, which will naturally convert into equity in the future, but we might not raise more of convertible debt in the future, or at least as aggressively. And we're going to rely primarily on preferred equity.
Yeah, I mean, that makes sense given your business model, given that your asset is Bitcoin, which is an infinite duration asset. But what could be the risk with raising convertible debt? What could be the risk with raising preferred equity as well?
Yeah. So risk from the perspective of the issuer being strategy, or from the perspective of the investor being someone who's buying it, or both?
We can do both.
Okay. Let's start with perhaps the company first. So
the company and its shareholders.
Yeah, fair. It's common equity shareholders, exactly. The risk that you've removed is clearly the maturity risk. And the risk you've introduced perhaps is the perpetual dividend paying requirement. And let's say Bitcoin is not what we all believe Bitcoin is, that it's not digital capital, it's not digital gold, it's not appreciating 30% per year. If it's, let's say, appreciating only at the rate of the S&P 500, about 14 or 15% per year, then we're still okay, because we just need to give 10% to these preferred holders, right? So we will still be able to fulfill all the dividends because Bitcoin is appreciating faster than their rate of return. But if it's below 10%, and if it's below 10% forever, then the business model doesn't really work. Let's say it is volatile. It's maybe 15 or 20% for the foreseeable future, but it has down years, it has a bear market, it stays, crashes 50%, stays there for many years, and then it recovers. And there's some risk over there in that scenario, which is, are you able to fulfill the dividends in that period, or are you not? And let's say the extreme worst case scenario is that you cannot. You still have the ability as a company to suspend the dividends, and if you suspend them, the company doesn't go into bankruptcy. There are just some rights that the preferred holders have, that if you miss dividends for a certain number of quarters, then they can elect a new board member to the board, or there's a penalty rate, like the rate keeps stepping up from 10% to 11, 12, all the way to 18. So there are certain rights that they have, but there's no scenario of default that the company is, going bankrupt or has liquidation of its assets, which is what happens with debt. If you missed an interest payment or a coupon, then there's technically a bankruptcy, and technically the debt holders then own the company. So that is the extreme worst case scenario, a suspension of dividend. But our intention as the company would be to never suspend a dividend and always fulfill the dividends in any scenario. And if Bitcoin is crashed 80%, 90%, we're still going to look to fulfill the dividends. And what we typically do is we raise proceeds through common equity, buy Bitcoin with it, and then use small slices of that funds that we've raised through common equity to but pay the dividends on the preferred.
Correct.
We could hypothetically also sell tiny chunks of Bitcoin, 1% per year, and fulfill all the dividend obligations. But it is more accretive to sell the common equity if it's trading at a premium to fulfill the dividends, as opposed to selling the Bitcoin and fulfilling the dividends, because the equity is valued at a premium.
Yeah, so can you just explain that for viewers? What do you
Sure.
mean when you say that the equity is valued at a premium?
So I think the best way to understand that is ignore all the debt first and imagine a new company that's only equity funded, common equity, and has Bitcoin on its balance sheet. If you hold $100 of Bitcoin and your company has no debt, no preferred equity, just common equity, and it has 100 shares, and the shares are valued at $1 each. So $100 of equity market cap, $100 of Bitcoin. The shares are not trading at a premium, it's trading at 1x mNAV.
Correct.
But let's say in many scenarios, for different reasons, for various arbitrages, tax reasons, or friction for buying Bitcoin for other institutional investors and whatnot, maybe the equity is trading at a premium. It's not trading at $1 per share, it's trading at $2 per share. So $200 market cap, but $100 Bitcoin, which means the multiple of asset value or multiple of net asset value is 2x. 200 divided by 100. So there's a 100% premium for the shares of the company. Now, what you will argue is it's in the best interest of all the shareholders and for the company to issue new shares at $2 share price, raise more money, and buy more Bitcoin. And let's play out the math. If they issue 10 shares, $2 each, they will raise $20 and they buy Bitcoin. And let's say Bitcoin's price was also $1 per Bitcoin, 100 Bitcoin, so $100 of Bitcoin value. They've raised $20. They're going to buy Bitcoin, which is worth $1 each. So they're going to buy 20 new Bitcoin.
Correct.
So they raised $20, they bought $20, but they only issued 10 shares because the shares were at $2 each, but they bought 20 Bitcoin. So Bitcoin count went from 100 to 120, shares count went from 100 to 110. So the ratio of Bitcoin to shares went from 100, 1 to 1 to 120 to 110. 1.2 is to 1.1. The Bitcoin per share increased.
Correct.
So effectively, although you diluted the shareholders and the number of shareholders are more, or the number of shares are more, but per share, their exposure to Bitcoin has increased. They have more Bitcoin per share. And if you're a Bitcoin maximalist, that's what you want. You want more Bitcoin exposure with time. So that's like the basic idea of why companies in the space choose to sell more equity at a premium and buy more and more Bitcoin, because it's traditionally dilution, but in the sense of Bitcoin per share, it's accretion. Bitcoin per share is going up.
People keep asking me where to buy Bitcoin safely in India. I use GetBit for all my Bitcoin purchases. It's the one I recommend to friends and family. GetBit is India's first Bitcoin-only exchange. So you know they're aligned with the vision of Satoshi. You can use my code DVJBTC for 30% off on platform fees for the first 3 months. So just go to getbit.com or install their mobile app, or just click the link in the description and enter DVJBTC in the referral page for 30% off on platform fees.
And I'll add one more element to it. Like, if you only have an equity funded Bitcoin Treasury company, you can argue there's no reason for it to trade at a premium. Maybe it should just trade at 1:1. Why should it trade at 2:1? But as soon as you inject some debt or some preferred equity or anything that is taking a fixed return into that balance sheet, and you also are buying Bitcoin with it, with the money raised through this sort of fixed income tranche, and as long as you believe that Bitcoin is appreciating faster than what their fixed return is, then the excess return is coming to the equity.
Correct.
So the equity is naturally outperforming the underlying Bitcoin then. The equity is appreciating faster than Bitcoin because you're stripping away part of the performance from the fixed income. You're enhancing the performance for the equity. So why wouldn't I pay more for the equity? If my Bitcoin per share exposure is going up, or if just the book value of equity is appreciating faster than the appreciation of Bitcoin, then I would be willing to pay more than 1x. It's the same way the traditional analysts and investors value banks. Banks trade on a price to book multiple. What is the book value per share? What is the price per share? It could be 1x, it could be 0.8x, could be 2x, 3x, 4x, depending on the fundamentals of the bank and how quickly are they appreciating the book value per share. So same thing over here, that you can have a company that has a premium to its book value because there is leverage built into the balance sheet and the equity is outperforming Bitcoin.
Correct. So the incentive for any investor, when they have the choice between Bitcoin and between, let's say, the common stock of strategy, when they buy Bitcoin with a certain amount, they know that they're going to get a fixed amount of Bitcoin, and that's it.
Correct.
And then Bitcoin can appreciate, that's fine, but their Bitcoin amount is fixed. But when they buy strategy or any other Bitcoin treasury company, they're giving themselves the option of increasing the amount of Bitcoin that they buy over time.
Yep.
And the cost that they pay for it naturally is that they pay a premium upfront. So when you give that $200 example, when someone is buying $100 worth of Bitcoin directly in that example, they get 100 Bitcoins.
Yep.
But when they're buying the share, they get 50 Bitcoins.
Yep.
But they buy it with the hope that the company can keep raising more money buying more Bitcoin, increase the Bitcoin per share slowly.
Yeah.
And eventually there will be a time when they will compensate for the premium they paid. And then beyond that compensation period, which is called the days to cover thing,
Yeah.
you just have bonus Bitcoin.
Yeah. I think that's perfectly articulated by you. And that's exactly why people would be willing to pay the upfront premium and make up for it with time, because the Bitcoin per share is expected to increase over time. And then 10 years out or 5 years out, you expect to have outperformed just buying spot Bitcoin with 1:1 exposure. But I would add one thing, which is this is one lever and one way of outperforming Bitcoin, which is the appreciation, increase in Bitcoin per share and the accretion in Bitcoin per share. But the second is leverage. Even if you hypothetically consider no future capital raising and no future equity issuance to buy more Bitcoin and Bitcoin per share going up and this accretive dilution, and you just assume that the balance sheet stays as is, there is no more capital raising happening at all.
Okay.
As long as there's leverage, as long as there's certain investors getting a fixed return and the asset is outperforming that fixed return, then the equity is going to grow faster than the asset is growing. So let's do the math very simply. $100 of Bitcoin, let's say $50 of preferred equity or debt, okay? Let's just call it fixed income. $50 of fixed income, $50 of common equity. No more capital raising happening for 1 year. Now let's say $100 of Bitcoin has doubled. It's gone to $200 in 1 year. The $50, let's assume the cost was zero. Maybe there's some cost, 10% cost or 1% cost, or let's assume there's a 10% cost.
Yeah.
So $50 has technically gone to 55. So 200 minus 55 is 145. So Bitcoin went from 100 to 200, it doubled, but the equity went from 50 to 145. It almost went 3x. So when you were thinking about buying the equity on day one, when it's at 50, would you only pay 50 for it? Or would you be willing to pay some premium to it because it is growing faster than what Bitcoin is growing? That is the question. So that is why you're willing to pay a price to book multiple of greater than 1, because that leverage exists in the system.
Correct.
And that is how a bank is valued traditionally. So I would say naturally Bitcoin Treasury companies will grow Bitcoin per share. They will issue more and more debt in the future, more and more equity, more and more preferred equity, and Bitcoin per share will keep growing up. But even without all of that, there is a natural reason for the equity to be valued at a premium, because it's appreciating faster than the underlying asset because of leverage. Yeah. I hope that makes sense.
Yeah, that makes sense. So you're going back to the same thing, that you're paying 10% on your obligations, but you have an underlying asset that is growing faster than 10%. So
Exactly.
Even if you don't raise any new money, this much is still true.
Yeah.
So that extra whatever delta there is, 20, 30, 40% delta that Bitcoin gives over the 10% you're paying, that will keep flowing to the common shareholders.
Exactly. And that is the same for buying a house with a mortgage of 6%, but your house is going up at 10% per year, 15% per year. You should not repay the mortgage if you suddenly have a windfall of cash. Just let the mortgage exist, because your house is going to appreciate more than the mortgage cost, unless you're finding it difficult to service the cash flows each year or something like that. But it's a natural principle in private equity. In a leveraged buyout, what do? You go out, you buy an asset, you expect the asset to grow at 12% per year, but you want to give 20% to your shareholders or your investors, your LPs, your limited partners. How do you get 12% to go to 18% or 20%? You lever up, you raise debt that gives only 6% to the debt holders, and all of that extra 6% kind of accretes to the LPs or the equity investors, and you boost the return 12% to 18%. Now there's also risk that comes with it, right? Because if it underperforms 12%, then the risk is being borne by the common equity.
And if it underperforms 6%, then you're underwater.
Yeah, and then the debt holders are losing money then.
Yeah.
So that's the whole thing. And that's why there's so many different kinds of debt that exist, different kinds of risk you take, different kinds of upside you take, and there's so much financial engineering and structural engineering that happens with balance sheets, traditionally as well, especially in private equity. And now that's kind of being replicated in some manner in Bitcoin Treasury companies.
Yeah. So just talking about that risk, there was a very interesting update from Strategy on the 1st of December, a couple of days ago.
Yeah.
That they now have a US dollar reserve as part of the treasury as well. Can you explain the rationale behind it and what do you hope to achieve with it?
Sure. So the US dollar reserve is something we created and announced earlier this week on 1st December, as you said, which is a reserve where we are holding 1.4 billion US dollars. This is capital we raised in just 2 weeks or eight and a half trading days. And that is sufficient to cover our dividend needs on all the preferred equity we've raised so far, which is about 7 to 8 billion dollars worth, where the dividends are 10% of it roughly, right? So $800 million is our annual dividend need, and $1.4 billion is about 21 months or 1.75 years, almost 2 years of dividend needs. So the reason we've raised it is to show the market, one, that there is no need for us to be missing a dividend payment. Like Bitcoin has crashed 30% from 120 to 80 to 90K, and our stock is naturally being amplified, levered. Bitcoin has crashed even more, and people are spreading this fear, uncertainty, doubt, all this FUD that strategy will miss a dividend payment, you will be screwed if you're a dividend preferred holder, and that they're worried about the next quarter. So we said that let's not wait until the end of the quarter to pay the dividends and show the market that we can do it. Let's just go out and raise the money right now for not just 1 quarter, but 8 quarters or 6 quarters, 7 quarters, and show them that the capital raising scale and velocity that we have is so high that there is no scenario where we are not able to raise money to pay the dividends. But people were also worried that what if Bitcoin crashes? Maybe you can pay it this quarter, but what if there's a prolonged bear market? What if Bitcoin is crashing to 50K, 40K, 30K and is staying there? What if your equity is being undervalued and trading below 1x mNAV? What would you do then? You would be screwed as a common equity shareholder, as the company. And our answer to that historically was no, we would not be screwed. We would always fulfill the dividends. Although we have the optionality of suspending it, and it's a powerful option, we would never use it. We would still fulfill the dividends either by selling the equity if it's trading well above 1x mNAV at a premium, but if it's below, just small tiny slices of Bitcoin, like 30 bips of our Bitcoin per quarter, 1%, 1.5% per year to pay the dividends, and we would still be fine. Our Bitcoin count would go down slightly, but Bitcoin would naturally recover and the whole engine would kickstart again, and we would go back into the same capital raising mode and increase Bitcoin. But people are still worried. And we said, okay, then why make you worry about a prolonged Bitcoin bear market and a scenario of us selling the Bitcoin in a bear market? We'll just raise that extra cushion and keep it as the dollar reserve to pay dividends for 2 years now. So even if Bitcoin is in a deep bear market for 2 years and a stock is crashing, you will still have dividends for 2 years. So we'll keep targeting 2 years, 1 year of dividends on the balance sheet. So that people are not worried about the immediate next quarter and how are we raising the money to repay the dividend, to pay the dividends. That's the broad rationale.
You guys are actually creating the playbook as you go along of how to run a Bitcoin Treasury company. Like I've been following you very closely, and I realized that as an investor, I'm heavily invested in MicroStrategy, disclosure. And as an investor, whatever concerns that I have, whatever keeps me up at night, I find very soon enough, Michael Saylor and Fong Li and you guys just in general, you just come up with one of your like quarterly earnings calls or some other announcement and you just address that concern. So I can see that when you say in every presentation you put that your number one priority is the common shareholder, like you want to maximize value for them, you're actually doing whatever you can to achieve that. You're ahead of the game, I would say. Still, the fact remains that MSTR has crashed from close to 470 at its peak to almost 150 recently, and now it's up to like 170, 190 range. How would you explain the reason behind this? Like Bitcoin has crashed from 126 to close to 80, so that's a 30-35% crash maybe. But MSTR has suffered a lot more heavily. What are the ways in which you can explain
why that happened?
Why that happened?
Sure. So you asked me right at the beginning as well, like what is the business model of strategy, or why does strategy exist, why invest in strategy? And maybe I didn't phrase it perfectly, but one simple way of answering it is the business exists to create kind of this common stock that is outperforming Bitcoin, or it's built to outperform Bitcoin over the long term, over 5 years or 10 years, through the process of issuing digital credit and amplifying your Bitcoin exposure, increasing Bitcoin per share, and all of these things. So what that means is you're trying to create an instrument that is amplifying the returns of Bitcoin, both in the short term and the long term. So if Bitcoin is going up 30% over 10 years, you're hoping the common stock is growing faster than 30%. But if it is crashing 30% in 1 year or 6 months or 3 months, it's also crashing more than 30%. And that's exactly what's played out over here, that the price of Bitcoin has crashed. And as we discussed, all of this preferred equity exists on the balance sheet, right? And they are going to still get their fixed 10%.
Correct.
So all of that excess loss in the short term is all being absorbed by the common equity. So that is why the common equity is crashing even more than 30%. And that's why in the short term, you'll naturally expect the common stock to crash more. And added to that, it just seems like empirically, if you observe the pattern for the last 5 years, the sentiment for the stock is very highly correlated to Bitcoin sentiment, right? Like if Bitcoin sentiment is good, Bitcoin is reaching new all-time highs. The sentiment in the stock is very good. There are new people learning about the company, about the stock, investing in the stock. And naturally, demand is kind of growing very rapidly in that time. And the premium to the stock, premium to Bitcoin rises. And the stock reaches new all-time highs and outperforms Bitcoin on the way up. But when it crashes, it's pro-cyclical. The sentiment in the stock also crashes a lot more. And it becomes very, very weak. And people who have just kind of gotten in recently haven't understood it are selling out. And people are panicking. They're spreading all this fear in the market. The large, long-term holders, the big institutional investors who understand the story are still happy. And they might still hold their position or buy more. The shorter-term hedge funds, arbitragers might sell, might buy, whatever. The individual investors, again, might do sell if they don't understand it, might be buying more if they understand it.
Yeah.
So that's the story. So the Bitcoin price has crashed, the mNAV premium has compressed because the sentiment has become super weak and because the losses are being absorbed by the common equity.
Yeah.
But if Bitcoin rips to new all-time highs, the excess returns will again come back to the common equity and you would expect the stock to outperform Bitcoin on the way up.
So I'll just push back on that a little. We had all-time high sometime in October, right? The 126K thing.
Yeah.
MSTR was still close to 50% below its top then. So this time, when we had that bull run to 126, MSTR didn't quite rise with it. So the mNAV compression that has happened, because I think it was November last year, so November of 2024, when the mNAV was close to 3.
Yeah.
And right now the mNAV is close to 1.15, 1.2, in that range. So the mNAV has compressed significantly. Now you can argue that what happened in November of 2024 was there was too much exuberance.
Yeah.
A 3x mNAV can be hard to justify because for a company like Strategy that already was sitting on hundreds of thousands of Bitcoin, for someone who is buying at that point, who is paying a 200% premium on the Bitcoin that they get, it will take a long time for Strategy to compensate and give them the equivalent of Bitcoin that they would have gotten had they just bought Bitcoin directly.
Yeah.
So maybe it was not a smart decision to buy then. Since then, the mNAV has compressed quite a bit, and now it feels more fair given the BTC yield that the company can generate.
Yeah.
So you're sitting at close to 650,000 Bitcoin today.
Yeah.
Is that right?
Yeah, that's right. Exactly 650.
Yeah, the December 1 update.
Yeah.
So right now, for you to double that stack, let's say, how long might it take?
So doubling the stack is one thing and doubling the Bitcoin per share is another thing. So let's talk about doubling the Bitcoin per share because that's what you should care about as an individual shareholder.
Correct.
Because we might have doubled the stack, but your Bitcoin per share stays static. And that is not good for you as a shareholder, right? You want to increase the Bitcoin per share. So if you think about numbers conceptually, if you say there's a 10% BTC yield each year, meaning a 10% increase in Bitcoin per share each year, then that means you would double the Bitcoin per share in roughly 7 or 8 years. And you know, that's the rule of 72. 72 divided by 10, 7. So you're doubling in 7 years. So, you know, that's a good sort of that's a goalpost that you can have. If the company is able to deliver 10% BTC yield per year for 7 years or 8 years, you would have 2x your Bitcoin per share. Which means today, if you buy the stock at a 2x premium and 8 years out, you sell the stock in the worst case scenario, not worst case scenario, but in a bad scenario at 1x. You know, it's no one is giving it a premium then and the outlook has become very bad, but so all you're getting is, you know, 1x. Then you would have still gotten the same return as Bitcoin. Although you paid a 2x premium now, because the Bitcoin per share doubled, so the compression in the premium is made up by the increase in Bitcoin per share.
Correct.
So if 10% for 8 years means 2x today is giving you the same returns as Bitcoin if you're exiting at 1x. Anything above 1x, if you're exiting, you're actually outperforming Bitcoin.
Correct.
Anything above 10%, you're actually outperforming Bitcoin. Buying below 2x, you're outperforming Bitcoin. So all of those things can kind of be a goalpost. So it again depends on your outlook of BTC yield in the future, which is your outlook of how much more credit will be issued, how much more equity will be issued, what will be the appreciation in Bitcoin's price, what will be a capital raising velocity, all of these things. And yeah, that's the way you can do some math at least.
Yeah, because when you were issuing the convertible debt, it's a product that the market already understands. So that was being gobbled up and you were able to raise significant chunks. And then there was the NASDAQ inclusion, which also gave you a significant amount of new capital that you again used to buy Bitcoin with. So there was a lot of Bitcoin buying that strategy did in 2024, which it also has bought a significant amount of Bitcoin in 2025, but it hasn't quite matched up in terms of BTC yield.
Yeah.
Right. So this year the BTC yield has been a little more compressed, and the euphoric mNAVs that we saw in 2024 are, I think, now in a lot more reasonable range.
Yeah.
So again, this is not investment advice, but I believe this is a much better time to buy strategy stock for the long term, medium to long term, compared to what it was in November of 2024.
Yeah, I mean, again, I think you should not be buying Bitcoin if you don't have a super long-term horizon. And again, you should not be buying the stock of any Bitcoin Treasury company if you don't have a long-term horizon. If you're a shorter-term trader looking to capture profits in 6 months, 1 year, 2 years, even 4 years, maybe, you don't have the mindset that is right for actually making value for yourself by buying these different stocks. So you definitely need a very long-term horizon. And I still feel like, don't want to use strategy necessarily as the only example, but for any kind of company being trading at a premium to its, let's say, fundamental value for brief periods of time, as long as you believe it's going to, make up for that premium over the long term, you'll be fine. And maybe it's the same case over here, right? And you're right, in November, there was this kind of exuberance in the market and we had a smaller base, which meant like when we raised $20 billion in 2024, the BTC yield we got, because of where the price was and because of the smaller base, we generated about a 75% BTC yield.
Across the whole year.
Across the whole year. This year, we've again raised about $22 billion, but maybe at a lower premium and different kinds of instruments, we've generated about 25% BTC yield. If we raise another $20 billion next year at, let's say, similar premiums, then we'll generate maybe a smaller premium. So it's naturally, as a company becomes bigger, you need to raise more and more capital at elevated premiums to generate similar BTC yields. And so maybe you naturally expect the BTC yield to compress a little bit as you become larger and larger. But the risk is also far lower than maybe the risk of a smaller Bitcoin Treasury company, which has a lesser track record, which doesn't have the proven execution capability, doesn't have the same access to capital markets, doesn't have the same trust in the management team. So maybe the rapid pace of BTC yield might slow down, but that also means the risk actually is kind of reducing as the scale is becoming bigger. Yeah, so I think that's the broad view that I have.
Yeah, for me, strategy is the Bitcoin of treasury companies.
Yeah, fair enough.
That's how I look at it.
Yeah, it's a space that has exploded in the last 12 months. There are 200 companies that are doing the exact same thing as strategy now, and everyone who's followed the playbook, many of them didn't understand it earlier, and it clicked finally last year when they saw a whole cycle play out and strategy emerge much stronger, much better after one whole cycle of Bitcoin and had outperformed Bitcoin massively. And they all realized that it's replicable, that you can actually do the same thing, and they should do the same thing. You can do it as a private company, as a public company. You can do it in the US, you can do it in India, you can do it in Japan, you can do it anywhere in the world with any kind of capital, where you can buy capital, you can buy Bitcoin, and you can lever up, and you can try to outperform Bitcoin. And you should try to do that. Why not? But there will be different risks that will come with it in different jurisdictions. There will be regulatory risks, there will be execution risks, there will be just capital raising ability risks, and all of those have been, at least mitigated to a large extent by strategy. So yeah, in some sense, it's become like a category of one. Metaplanet has proven to also execute really well. So, they're up there. There are large Bitcoin mining companies that kind of tried to do it for a bit, but didn't really go all in. They've started pivoting to AI, which kind of makes sense with their business model being, kind of these large energy companies almost. So there are a lot of more pure play Bitcoin Treasury companies, but yeah, they still have to prove themselves. They have to show that they have access to capital markets the same way we do. And and hopefully with time a lot of them will prove it, and it'll be a good thing for strategy. It's good to have this natural set of competitors that are all buying Bitcoin and they're all spreading Bitcoin across the world and improving the knowledge, the mind virus of Bitcoin, and leading to more adoption of Bitcoin and making it easy for people across the world to buy and hold Bitcoin, and the Bitcoin price will go up, which means that we will benefit and we will raise more capital and Bitcoin per share for us will go up even more. So, all of this is good for Bitcoin.
Yeah, that's an interesting thing, because usually whenever a company operates in a particular industry or space, it doesn't like too much competition. But in the case of strategy, in some ways competition is not good, because you're competing for still a definite pool of capital that can be raised. But in other ways it's really good, because whether strategy raises it or whether Metaplanet raises it or whether it's Smarter Web company or some other company, in the end they're buying Bitcoin with it. So in the end they're creating more demand for the underlying asset.
Exactly. And Bitcoin itself is just so tiny right now. It's $2 trillion. And you think about all the wealth in the world being $900 trillion or $1 quadrillion. And it's like the potential explosion in the price of Bitcoin for the next 10, 20, 30, 50 years is just, it's mind boggling. And then you look at within that Bitcoin Treasury Companies and what is their total equity combined, what is their total fixed income instruments, the market cap of all of them combined. For us, it's like $8 billion of preferred, $8 billion of convert, $16 billion. Add up everything else, maybe 17, 18, $20 billion. And what's the total fixed income asset pool in the world? Like $300 trillion. That's the amount of credit that exists in the world. Like most of it being sovereign bonds from the US government to other governments to a lot of corporate bonds to a lot of mortgage-backed securities. And those are different forms of credit. And we are trying to create digital credit that's backed by digital capital that's superior to the traditional credit. It pays better. It pays a higher return. Yeah. It's backed by more assets on the balance sheet. It's a very liquid asset. You can buy and sell it very easily. So there's just so much potential market cap expansion for the whole space and then within that strategy. So it's really, yes, in some sense, we are competing with the same limited pool of capital, but it's not really a limited pool of capital. It's just like it's a knowledge thing. And as awareness grows for Bitcoin and Bitcoin backed credit, that potential market cap is just going to like expand so massively.
Yeah. There has been one setback on this front where MSCI recently, there was, I don't know if it was an official report, but there was news that MSCI is considering removing strategy from some of its indexes.
Yeah.
What do you have to say about that? How is it going to affect common shareholders?
Sure. So what's happened is in October, MSCI, which is this company that has sort of it creates indexes or indices, and different passive investors like BlackRock, Fidelity, or others might create ETFs that track those indices. That company, MSCI, declared that at the time Metaplanet was raising a lot of capital, a lot of equity capital, which would have maybe increased its share count by 50-60%. And it said that it will use all the capital to buy Bitcoin, which is what all of us do as Bitcoin Treasury companies. MSCI was just worried that, the share count is increasing too much, which means that the market cap is going to increase a lot. And that means their weightage to the company needs to increase because it's all market cap weighted usually, right?
Correct.
And they're using it to buy Bitcoin. And then they frowned upon that. They said that, oh no, that doesn't make sense to us if you're raising so much capital just to buy Bitcoin and you're forcing us to buy more shares of you in our indices or raise our exposure to your company. And so what are we doing? We're going to pause any rebalancing for your company and we're going to launch this consultation period for 3 months, inviting people to tell us if these Bitcoin Treasury companies should be in the indices or not. And our view is that they should not be and we're planning to kick them out. Or we're planning to, exclude them. And they included strategy in the list and maybe another 20, 30 companies. So that consultation period is going on till 31st December. And on 15th Jan, they will sort of make the decision and announce it publicly as to what is happening with this. So there are different market participants, including strategy, that will be in discourse with them privately, publicly, issuing letters, having discourse, talking about what our view is. And there might be other market participants talking about what their view is. It could be banks, it could be research equity analysts, it could be passive index issuers like BlackRock, like Fidelity, who actually make money issuing these indices. So the view is for us as a company that, one, we aren't a passive investment company. which is typically excluded from equity indices. If you're an investment company under the 40 Act, which from the SEC, which talks about what investment companies are, if you aren't one, then you naturally are an operating company, which has operations, which has a business, has people, has talent, develops products and services, and creates value for its shareholders. You're an operating company and you belong in these equity indices. And we believe we are an operating company. We have talent, we create products, we create value for our shareholders. We issue these digital credit instruments, which are superior forms of credit. And we have a lot of Bitcoin on the balance sheet, which are not passive holdings. We can do whatever we want with them. We choose to hold them today. We can lend them out in the future. We can use that capital to buy other companies. We can use that capital to innovate and do R&D. We can use that to generate yield on Lightning if we want. We can do thousands of different things. We aren't regulated as an investment company is to passively hold and just do one thing and have one fixed mandate. We have all the flexibility as the management team and as the board of the company chooses. So we are an operating company, and hence we should belong in equity indices as long as we fulfill the criteria that they've already set out, that they've publicly disclosed, and that they abide by at all times. And the whole point of having these passive indices is that you want to take away the active nature of investing. And as the index creator and as the investor, you don't want either one of them to be actively making decisions and choosing one thing over the other. That's exactly what you're trying to remove. You're saying that if you're an operating company and if you're meeting this market cap liquidity thresholds and if you are meeting these revenue profit thresholds, and as long as you fit these buckets, you belong in the index. And that's what the market is dictated, and that's why your shares are trading where they're trading, and that's why we're going to just include you in the index. It's not their job to primarily make a lot of active decisions.
Correct.
So it's kind of also just a bit funny that they're trying to do this now in this instance. Maybe they dislike Bitcoin, maybe they're loud actors in the room that dislike Bitcoin, maybe they're loud people influencing them that dislike Bitcoin. And hence you're seeing this sort of tension in the market. And in the worst case scenario, if there is exclusion and there are some outflows from the index, there'll be maybe some short-term pressure on the stock because there'll be incremental supply that will come into the market of those selling of those shares.
Correct.
And then the company will recover from it, and the share price will recover from it. There will just be this unhappy perhaps scenario for investors tracking that index because they're not getting the benefit of the appreciation of Bitcoin's price, and they will just be getting exposure to traditional companies. They will not get exposure to digital equity. And maybe what the Nasdaq 100 is benefiting from is having strategy in it, and maybe in the future they will have other digital technology companies and digital capital companies, and they will benefit from the appreciation of the stock price of Bitcoin. So it's Bitcoin doesn't need strategy. Strategy needs Bitcoin.
Correct.
And strategy doesn't need different indices. And Bitcoin Treasury companies don't need different indices. Like those indices need treasury companies to stay relevant and grow and outperform other different indices and other forms of investing. So that's the view.
Yeah, I also wonder if there's a short-term mindset creep that has happened because in the last 1 year, strategy stock has crashed by 50-60% at its worst day. So just that 1 year underperformance might have induced some people to become even more vocal about do we want to include this company? And especially if you don't understand the underlying business model, if you don't understand how robust it is, if you don't understand how little the leverage is, if anything, strategy needs more leverage rather than reducing it. So if you don't understand these things, I think it's easy to be swept away by just looking at the share price over the last 1 year and being like, okay, maybe we should reconsider decision of including them in the index in the first place.
Yeah, fair. I mean, that could be one of the concerns, that because there's been this recent underperformance and share price decline, that it's kind of given them the jitters and they're reconsidering just natural inclusion of companies like us. But again, I think it's if you want to create a set of rules and follow them passively, then you should just be looking at the rules and what those rules are saying. And if you're changing the rules, then and you believe that's appropriate for the company and for the other investors tracking your index, then fine. I guess you could go ahead and do that. And I think that is their concern, that, if we include these companies and they issue more shares, market cap goes up, we increase their weightage, and all of that happens. But what if the share price declines? Then the market cap weightage goes down, and then they need to sell, and that creates like maybe more selling. So maybe that could be part of their concern. So I guess now, we just have to wait and see what their reaction is to
Correct.
the final sort of consultation from different actors in the market. And it would obviously be in our mutual interest to remain included.
Correct.
But if we are excluded, then so be it. We would continue to execute on what our strategy is. And Bitcoin is going to appreciate in the long term. That's our view. So, everything is going to work out anyway.
Yeah, that sounds good. I have one last question for you. We kept coming back to this analogy of a bank.
Yep.
When you're trying to explain what strategy does, how the business model works. You also mentioned that right now, what strategy does with its Bitcoin is it just sits on it. But there's a possibility to do more with it. Is that something that the team, Michael Saylor and other people in the team, is that something that you actively or even sometimes discuss? Is that something that you've considered doing in the near to medium term?
So we don't, let's say, actively discuss that on a daily basis. And what we have done is we've sort of considered all options of what we should be doing with our Bitcoin. And right now the best decision is to hold the Bitcoin. But what Michael and Fong have said publicly as well is that the day a big bank is willing to custody Bitcoin, hold Bitcoin, and borrow and lend Bitcoin, maybe that's a interesting opportunity to partner with a bank to lend Bitcoin out and generate yield. They keep part of the yield, we keep the remaining, because they have the expertise and the diligence capabilities to underwrite loans correctly. And that could be an interesting way to do it. You can argue that we could do it with other Bitcoin players in the market today as well. But it really comes down to, do you need to do it? And if we have a situation where there are investors and there's a large pool of capital in the market that just wants yields that are superior to 5, 6, 7, 8%, they want a 10% yield on a fixed income instrument. And if you can create that and sell it to them and buy Bitcoin that's appreciating more than 10%, then why do you want to lend out the Bitcoin? You're just creating value by doing this simple, transaction. You're swapping 10% yield for Bitcoin yield or for Bitcoin appreciation. And just by doing that, you are outperforming Bitcoin. And you're not creating more counterparty risk by lending out the Bitcoin and, figuring out if your borrower is going to repay or not. And you're still getting the 30, 40% of Bitcoin returns as opposed to, a fixed return that the borrower would give you. So for all those reasons, right now, we don't see any need in the immediate future to be lending out the Bitcoin. But who knows, 10, 50, 100 years from now, if you're sitting on a large pile of Bitcoin, and if Bitcoin is sort of emerged as this truly the true base layer of money, or Bitcoin is the capital asset for all banks, for all companies, for all governments, then with all the Bitcoin on a balance sheet, if no one wants 10% dollar yield anymore because everyone wants Bitcoin yield, everyone's denominating everything in Bitcoin, then at that time we can't just be sitting on the Bitcoin. And at that time we would be doing something else. It could be, you become an insurance company, a bank company, go on an M&A spree, do a lot of innovation and R&D. You could do so many things. But we don't need to do that today. Today we can just be a really high performance company by sitting on the Bitcoin.
This has been amazing.
Thank you, Digvijay. Thanks for having me.
Thanks for coming on, man.
Of course, I think we need to go party now and join the Bharat.
Yes.
Yeah? Awesome.
Let's do this.
Let's do it.
Awesome, yaar.